start. So, welcome everybody. Thank you so much for joining today. I'm Selina. I'm one of the money mentors here at Women's Wealth. And our Finance on Friday Women's Wealth broadcast is where we spend half an hour talking through some of the latest information and views around the topics that matter to our members. I want you to feel free to contribute to our session today. We thank you for your input in advance. We welcome questions, comments, and these can be sent through via the chat box, or if you feel, happy enough, feel free to come off mute and share. This time is for you. We want you to feel free to ask any questions that you may have about insurance and protection, and I'll cover as many of the questions as I can. It is important to say that we can't offer bespoke financial advice just because we don't have enough time to get to know you all individually, but we will try and answer as many questions as possible. So could you keep the questions as sort of general as possible, but we will try and answer them. Um, so thank you so much for joining. I want you to think about this question for me today. So, what would happen if your income stopped? And protection and insurance is one of those topics that we feel really comfortable insuring things like our car, our home. We might even insure things like our mobile phone. And I recently bought a blender. So I'm just going to tell you that story because when I went to buy the blender from Argos, they invited me to add on some additional insurance for it. But the truth of the matter is, the risk to my financial future by my blender breaking down is minuscule. So I didn't really feel like I needed to protect that risk. I can always replace my blender using my spare income or my savings, or I can go without a blender for a period of time. It's not a financial crisis. And you will find that, there are many people trying to flog you insurance for a lot of different things. And today's webinar is about getting you to think about with the possessions that we have, what level of risk do we have to those possessions? And when we are thinking about insurance, the idea is that you insure, the things that, if something was to go wrong with that item or you, essentially, I'm talking about you, what is the risk? What would be the fallout? And we should insure the things that have the biggest impact in terms of the risk. So that's what this webinar is about today. And I want you to think about what would happen if your income stopped tomorrow? What happens and what happens if you break, essentially? Today's session, we're going to talk about the most common sort of insurance policies that you're probably very aware of. We're going to cover life insurance, income protection insurance, critical illness insurance, and we're going to talk about the power of putting a life insurance policy into trust. And one of the biggest things which I think you can take away from would be some of the common mistakes, learning about some of the common mistakes that people make when they are setting up their own insurance policies themselves. So by the end of this webinar, I want you to understand what each of these policies do, how they differ, and how to decide which type of protection may be suitable for you in your individual circumstances. And I think it's just really important to begin by explaining why financial protection is very important. And the reality is that life is full of uncertainties. Most of us plan for major milestones, such as, buying a home, raising children, building a career. But none of us plan or prepare for the possibility of becoming seriously ill or being unable to work. So I want you to imagine for a moment that if you were unable to be in work for 6 months, 1 year, or even longer due to injury or illness, would your savings be enough to cover your outgoing expenses? Could you continue paying your mortgage or your rent? Would your family be able to maintain their lifestyle? And I know that these are difficult questions, but they are exactly the risks that protection insurance is designed to address. And if you think about it, for many people, their future earnings represent their greatest financial asset. So if you're someone that earns around £40,000 a year, and if you have 25 years left until retirement, you could potentially earn 1 million over the remainder of your working life. And protecting that income is often just as important as protecting physical assets. I'm so sorry, my glasses keep on slipping down. My nose is sweating due to the heat. So if I keep on adjusting my glasses, that's why. I'm smelting over here, I'm melting. Um, so protecting your income is, even more important than protecting the physical assets. And like I said, the good news is that there are insurance products available today designed to provide, financial security when life takes an unexpected turn. So we're going to start with talking about life insurance first of all. And it's probably the most widely recognized form of protection insurance. And in simple terms, life insurance will pay you a lump sum to your chosen beneficiary, not to pay you, sorry, your lump sum to your chosen beneficiaries if you die while the policy is active. And active means you have to be paying for those premiums. If you stop paying for those premiums, then they don't owe you, the lump sum. So you have to make sure that you continue to pay. And the purpose of life insurance is to provide financial support for those who depend on you financially. So, for example, if you imagine, a couple or a single person with children and a mortgage, if one parent were to pass away unexpectedly, the surviving family members could face significant financial challenges. And a life insurance policy could provide funds to pay off a mortgage, to cover household expenses such as rent and council tax, to support children's education, and then also to replace lost income. And on the slides, I've got two main types of life insurance policies that you may come across. And the first is term life insurance. And this provides cover for a specific period of time. So it could be 20 years or 25 years. And if the insured person dies during that period, the policy pays out when that person passes away. And the second type of policy is called a whole of life insurance policy. And this type of policy lasts for the insured person's entire life and guarantees a payout whenever death occurs. And again, it's provided that the premiums are maintained. So provided that, you're continuing to pay for the premium. And term insurance is generally the most common option because it's more affordable. And also, it can be aligned with major financial responsibilities, such as paying down a mortgage. So you might have someone who has a decreasing um, uh, mortgage. So every year, the amount that they pay is going down, and they might align a term policy. If they've got 25 years left on that policy, they might align their term policy to that 25 years. And then also if they are raising children, so you might have a policy in place until your children are, independent and grown up. But it's important to remember that life insurance is designed to protect others financially after your death. So you don't get anything whilst you're alive, but it does provide benefits if you become, uh, uh, sorry, if you become ill or unable to work for those situations. No, it doesn't. So no, that's wrong. Sorry. Yeah, no, I just thought that. Sorry, I'm just reading from a little bit of a script here. No, that's talking about income protection. But onto the slide, I just want to draw your attention to some of the terms that you may come across when it comes to life insurance policy or any insurance policy. So you've got indexation, which means that that lump sum that gets paid out will grow in line with, whatever indexation you put. So it might be inflation, for example. So that just means that if you have a life insurance policy that's supposed to pay you out 200,000, that 200,000 will grow, as time goes by and costs get more expensive because 200,000 pounds, the amount that it can buy you 20 years ago is a lot less than now, so you have to make sure that it's indexed. So it's very important to have that on there. And then you might see level level insurance, like I mentioned, and then also decreasing cover as part of as part of your life insurance payment as well. So they're doing two things. Level, it just means that you're guaranteed the amount that you've signed up for with a level term, so it doesn't decrease. And decreasing is where the amount that you will get, the lump sum will decrease over time. So if you've got a repayment mortgage, you might have a decreasing life insurance policy that goes down as you pay down the mortgage. So those are the different types and some additional terms that you may come across when you are setting up your policy. We do like indexation here because it's covering you and just setting the appropriate sort of level or decreasing term for your life insurance policy. In terms of income protection, so income protection, many people underestimate the financial impact of being unable to work due to injury or illness. And while some employers provide sick pay benefits, these are often limited in duration. So I don't know if you're familiar with anyone who's got off from work sick. We do know that things can become quite tight financially if they are unable to get back to work because workplace benefits, particularly sick pay, may only last for a certain amount of time. And it's really important that you understand what your sick pay benefits are from work as well, so that you can make a plan for that. But income protection insurance is designed to replace a portion of your income if you cannot work because of a medical condition or injury. And instead of paying a one-off lump sum, income protection typically pays a monthly benefit. So most policies provide between 50 and 70% of your regular earnings. So if I give you an example here, let's say that someone earns £3,000 per month. If they have an income protection policy covering 60% of their income, they're likely to receive approximately 1,800 per month while they are unable to work. And again, this money can help them cover the mortgage payments, the rent, utility bills, food and household expenses, and other essential living costs. And one of the important features, which is shown on the slide, is the deferral period. So this is the amount of time you must be off work before payment begins. And this is what you agree when you set up your income protection policy. And common deferred periods are maybe 4 weeks, maybe 16 weeks, or maybe 26 weeks, which is equivalent of around half 6 months. So if you've got a quite generous sick pay policy that pays you for 6 months, you would defer before you set up your income protect or before you get your income protection policy, so that you're not overinsured. And we're going to talk a bit more about that. Um, Income protection is considered one of the most valuable forms of insurance because it protects your earning power. And like I mentioned, unlike critical illness insurance, which we'll discuss next, income protection can cover a wide range of sort of illnesses and injuries um, uh, that prevent you from working. And again, on the slide, I've got some terms that are quite important when you are setting up your income protection policy. The first is own occupation. So we prefer own occupation than any occupation, and that just means that they are assessing whether or not you can do your job, your job that you're sort of certified to do, rather than judging you on whether you can do a version of the job. So own occupation is what we would suggest someone has. And then I want to talk about these other terms which relate to the premiums, and the premiums are the monthly payments that you make for your insurance policies. So you might see guaranteed premiums here. And they're good because it just allows you to budget. So you've got a fixed monthly cost for your insurance premiums that you're paying. So guaranteed premiums is kind of what we would suggest as well. And then also there's something called a waiver of premiums, which is a bit of an add-on. And it just means that if you are unable to work due to injury or illness, that your sort of premiums are sort of paused, but you're still covered. So these are some things to look out for, plus the previous slides terms as well to think about as well. Next, I want to talk about critical illness insurance, and it works differently from both life insurance and income protection. So rather than paying a monthly income, it provides a one-off lump sum payment if you are diagnosed with a serious medical condition that is specifically covered by the policy. So it has to be like a named illness. It's not whether or not you can work or not, it's you're diagnosed with a named illness. And some commonly covered conditions include certain types of cancer, heart attack, stroke, multiple sclerosis, and the exact definitions and covered conditions vary per insurer. So it's really, really important that you read the policy details very, very carefully. And for example, imagine someone is diagnosed with a serious illness and receives a critical illness payout of £100,000, and they could use those funds in whatever way they choose. So, for example, they might pay off part of their mortgage. They might reduce the financial pressure during treatment if they're having to get some sort of treatment. It could be used for adaptation to your home, cover additional care costs as well. And it could just support the family whilst you are recovering. And again, a key point to remember around critical illness insurance is that it's based on a specific diagnosis, not whether or not you can work or not. So, that is the big difference. And again, we've got some terms, and actually the first term of exclusions also relates to income protection as well. So anything related to sort of injury or illness, if you've got a pre-existing health condition, a insurance company may exclude cover for that pre-existing illness or anything related towards it. So you might often see, you know, if you have experienced any sort of mental health issues and you explain that to your insurer, you will see on your policy that it has an exclusion for mental health, depression, and it might say additional related illnesses as well. So something to bear in mind is the exclusions. Um, Sometimes if they do cover you with these exclusions, they might sort of front load the policy, so it might cost you more as well. So they might allow you to be covered, but they might charge a bit more upfront for it. So those are the ways that they do tend to handle pre-existing conditions and illnesses. So something to bear in mind there, but also really important to know. And then also with critical illness policies, they may include cover for children as well. I know that when I had a critical illness policy, I had my son included on that until he was sort of 21. Some go up to 23, or if they're still in education. So bear that in mind as well. You can get cover. And sometimes you might find some of these covers together as well. So you might get a life insurance policy and you might have critical illness, or you might get income protection and critical illness. So sometimes these policies can be created together. Additional benefits that you might see on a critical illness policy is funeral cover as well. And then sometimes some policies offer sort of dementia care, so sort of later life sort of illness care and cover. So some things that might crop up that you might see to sort of think about. I wanted to talk about the importance of putting life insurance in a trust as well. So you've probably heard of, putting things into trust. So I want to just talk about what a trust is, just very briefly, very high level overview. So a trust is a legal arrangement that allows the proceeds of life insurance policy to be paid directly to your chosen beneficiaries rather than becoming part of your estate. So again, when you die, all of your assets that you've accumulated, your pensions, pensions from 2027, previously they were outside of your estate, but all of your assets, that your home, other investment accounts, savings accounts that you have, all become part of your estate. And putting a life insurance policy into a trust allows it to sort of bypass your estate. And it also allows you to set out who gets what and who's the sort of trustees of your estate as well. So the people involved are the settlor, which is the person placing the policy into trust using the policy, usually the policy holder, so it would usually be you. The trustees, these are the people that you trust to actually administer your trust for the benefit of the beneficiaries. So the beneficiaries are the people who receive the proceeds from your policy. And it has three really important advantages. And the first is, when someone passes away, there's a lot of admin to do, loads to sort out. So, it the proceeds of your life insurance policy will hopefully get to your family a lot quicker. Things like probate can take several months and in some cases much more. And if the policy is held in trust, the insurer will usually pay the proceeds directly to the trustees for the beneficiaries, often more quickly. And it just means that your family may have access to funds when they need them the most. Also allows greater control over who receives the money. So a trust allows you to specify who should benefit from the policy proceeds. For example, it could be a spouse, so a husband and wife, or a civil partner or a partner. Could be children, grandchildren, and other dependents. So, you can also make arrangements for younger beneficiaries as well, who may not be old enough to manage sort of large sums of money themselves as well. So that can all be put in a trust. And another valuable benefit, which we probably don't think about, is the potential for inheritance tax benefits. So in many cases, placing a life insurance policy in trust, it means that the proceeds do not form part of your estate for inheritance tax purposes. And this can help the policy payout from increasing the value of your estate. So if it's in trust, it's separate, it's away. It just means that, hopefully you get to keep more of your, nil rate band. So I've got an example here where Sarah has a £500,000 life insurance policy intended to support her family. If the policy is not in trust, the payout may be included as part of her estate, which will increase it quite significantly, and it may also delay probate. But if it is, in trust, then that £500 can be paid out directly to the trustees for the benefit of the family, potentially much faster and with the additional estate planning advantages. So again, it's valuable protection for you. And again, it's great for if you have dependents, if you've got, mortgages, and also for estate planning considerations. That's when you might put it into trust. I've got a chart for comparison. So now we've explored each product individually. We can compare them side by side. So again, life insurance pays when the insured person dies. Income protection pays a monthly benefit if illness or injury prevents them from working. Critical illness insurance pays a lump sum when a covered serious illness is diagnosed. And let's take an example. So let's imagine that someone has suffered a serious heart attack, and if they survive but are unable to work for several months, life insurance would not generally pay anything because the person is still alive. But income protection may begin paying a monthly income after the deferred period that we discussed. And then critical illness insurance may pay a lump sum if the heart attack meets the policy definitions. So, this example sort of highlights why the products are sort of complementary to each other. They're designed to address different risks, and they often work together as a broader financial protection strategy. And which cover might be right for you? The right solution depends on your personal circumstances. So, for example, a young professional with no dependents may place greater emphasis on income protection because their future earnings is their primary asset and what they want to protect. And a homeowner with a mortgage and children may prioritize life insurance to protect their family. And also, they should also consider income protection because obviously it covers them if they are unable to work, so it covers the income for their family and mortgage, and then also critical illness cover as well could be, a massive added sort of bonus. And if you're self-employed as well, so again, income protection is often particularly important because you're the employer. You might be the employer. No one else is paying that for you, so you might not have access to a sick pay scheme. So again, really important to consider which product is for you, and you might ask yourself three questions. First, who depends on my income? Is it just yourself? Is it kids? Is it, you might be the squeeze? Are you supporting, elderly parents? Who's dependent on your income? Second, what would happen financially if you could not work? And then thirdly, what financial commitments would remain if I experience a serious illness or if you experience a serious illness? And often it's everything. The financial commitments, unfortunately, do not go away, if we become ill. So I hope you do consider, putting some of these policies in place. The final thing I wanted to talk about, and I don't know if it's very clear, so apologies if it's not, but I just wanted to talk about some common mistakes that people experience when they are setting up these policies. And sometimes these mistakes are only discovered when you try and claim or when your circumstances change. So mistake number one is being underinsured. And being underinsured means you don't have enough cover to meet your financial needs. And this is quite a common mistake. So, for example, someone may take out a £100,000 life insurance policy when they have a £250,000 mortgage still outstanding. They may have two dependent children as well. So children need a lot of support between now and adulthood, and the household expenses rely on their income. So in this situation, the payout will not be sufficient to support the family financially. So, you know, we need to consider things like, outstanding debt, mortgage balances, future education costs for children, ongoing family living expenses, and the loss of future income. So, a good question to ask is, if something was to happen to me tomorrow, would this amount genuinely support my family in the way that I intend it to do? So being underinsured is another thing. But also equally being overinsured is another thing as well. So, some people do pay more for cover than they actually need, and that can have an impact on sort of affordability. So if you are paying for, let's say, a level cover insurance, a life insurance policy, and you've got a decreasing mortgage, that the outstanding amount that you're paying on the mortgage will be decreasing, but you're paying, over the odds for that insurance policy when actually you may, be able to pay cheaper. It may be cheaper to pay for decreasing cover as well. And that can happen if, children grow up and they're independent. Like I said, your mortgage value has significantly reduced, and you've also maybe paid off some debts that you had. So, the amount that you need may not be as much as what you're insured for. Another mistake could be choosing a policy term that is too short. And this is something that I see quite often. I see people with mortgages and they've got like maybe a 25-year term, but the mortgage just falls just short, just shy of that mortgage term. So for example, someone takes out a 15-year life insurance policy because the premium is cheaper. And, affordability is a consideration when we do set these things up. The mortgage has 25 years remaining. So it just means that you get to the end of that life insurance policy term, 15 years, and you've still got another 10 years whereby, there is that risk to paying your mortgage. So we need to think about a term that is going to suit your mortgage duration, your children's dependency period, any planned retirement age as well. So you can set up these policies to go till end of mortgage and, when you expect yourself to retire as well, and any future financial commitments. Sometimes the cheapest option is not always the most appropriate option. Mistake number 4 is relying solely on employer benefits. So many employees do receive benefits through their employer, and it's important that you understand what they are. And it could be things like, death in service cover that you've got. They might provide you with income protection. So they might provide you with some sort of payment, and then also some critical illness benefits. And they're designed to get you back to work typically. And they're often very, very valuable. But what some people do forget is the fact that actually, if you change jobs, you don't have that benefit anymore. If you become self-employed, you don't have that benefit anymore. And also, if you lose your job, you might not have that benefit, or you don't have that benefit anymore. So definitely something to think about. And it's important to maybe have some protection outside of work, if you can. Mistake number 5 is not reviewing cover after a major life event. So protection insurance should not be something you buy and then forget about, because our lives change enormously over time. So it could be marriage, it could be divorce, having children, buying a property, taking on a larger mortgage, career changes, becoming self-employed. A policy that was suitable 5 years ago may not be suitable for your needs today. So always do a review. Another mistake is focusing only on price. So when comparing policies, many people will solely focus on the monthly premiums. However, cheaper policies may involve shorter benefit periods, longer waiting periods, and lower levels of cover. And there might also be more restrictive definitions of illnesses as well. And the objective should be value and suitability, not simply the lowest cost. So, I'd much rather not have cover for my blender, as I told you the story to begin with, and make sure that I've got life insurance cover and income protection cover, because they are so much more valuable. So I can forego that. And the final and it's a big one, final mistake would be not disclosing medical information as well. So insurance relies on full and accurate disclosure, and they do a bit of a test. Was it just sort of accidental? Was it just an oversight? They have a little bit of leeway, but deliberately not disclosing sort of some sort of medical information can completely sort of void your application. So you need to be honest about your medical history, whether you smoke or vape, any previous illnesses, dangerous hobbies, or existing conditions as well. So you need to provide the full information when you are applying for any type of insurance. And I think the key message today is that the biggest risk is not necessarily, having no insurance at all. It's kind of like having insurance that looks adequate on paper, but fails to provide the protection that you actually need when life changes and claims occur. So it's really best to review regularly and evolve your insurance alongside your personal changes. I think I've ran close to time. Let me just check the time. If anyone has, I've got some time. If you have any questions, do let me know.
I've got one, Selina.
Okay, yes.
The when you said decreasing insurance,
Yes,
life
yeah.
insurance, it sounded inferior to the others.
Oh, okay.
So when no, it just does, you could have it increasing level or decreasing. It's like, well, why would I have decreasing?
Yeah.
And then you explain the mortgage. If the mortgage is being repaid, you owe less each year, so
Yeah.
your cover can decrease in line with that. But what about other things that decrease? I'm thinking of like using family income benefit policies.
Yes, that is another policy. Yes. Yeah. That's
Yeah,
an
so
alternative.
that's about the length of time your children are still dependent on you, really, isn't it? That's why they call it family income benefit. So it's a decrease in cover, but it pays out normally a lump sum every year. So
Yeah.
the amount that's insured for every year the policy goes by gets smaller
Hmm.
because it's
Yeah.
only going to pay out until such and such a date. And every time you survive a year, the sum assured is smaller. So the cost of that is much lower than having the same level of cover throughout a policy. So, um,
Yeah.
but that is effectively decreasing again, isn't it?
It is, yeah, and it is definitely an alternative if, and again, affordability. So we want to make sure that any cover that you have is affordable because we often are paying these covers for quite some time. So, family income benefit, if you are parents, it's a really good sort of option as well. So thanks for bringing that up because I was going to include it, but I was like, I'm not sure. Let me include the main three, but it is an important
Yeah,
one.
and I think part of the work that we do always with our members is to really accurately map the risk and
Yeah,
buy the insurance, which is the good value cover for that
yeah,
risk.
yeah,
Because over
absolutely.
insurance is unnecessary expense, isn't it? But
Yeah.
under insurance can be catastrophic. So
Yeah, absolutely. So it's important that you have some insurance in place. We'd rather you had some than none, and we'd rather you have the one that's affordable and right for you as well. Temi, I can see a question. You said, is it better to get a policy that covers an illness but with loading, or one that covers everything except that illness and requires yearly review? And what's the process to put it in trust? Do we do that through the insurer? So yes, so yeah, typically life insurance policy holder insurers should be able to tell you how to put it in trust with them, and they should be able to arrange that. And in terms of, is it better to get a policy that covers an illness but with loading, or one that covers everything except that illness and requires yearly review? I would say it depends on you and the illness. If you would feel better with that cover and you can afford to pay the additional, then then why not? If you are able to get covered for that illness and you can afford it based on the premiums that you're paying, why not do that? It gives you peace of mind that if anything goes wrong with you based on that illness, that you will be covered. I would say. So that would be my answer. You know, and
I think
we
the
do.
reason they tend to charge more, so they say you can have the cover, but we're going to charge you more, so they load the premium, is because you're more likely to claim because of that vulnerability. So
Yeah,
like if you can get insurance, you're kind of like it's like perhaps I should have it because I am vulnerable around that
yeah,
particular thing. So I
yeah.
think there's nothing more important, I think, than being, you know, than our health and well-being and making sure
Hmm.
we've got everything in place that we need
Yeah,
around that. I think it's a good use of money if you can afford it.
yeah. And definitely, I would say, there are some illnesses that the insurers won't cover. So if they are willing to cover and you can afford it, then, like you say, it's best to be covered where you can. Um, any more questions? And Janet, I saw your comment. I have been calling it a heat wafer to remember to eat ice cream. Yeah. Um, any other questions before we wrap up? And again, like I mentioned, feel free to come off mute if you have a quick question that we can try and answer for you. Bye, Melinda from France. Okay, thanks, Wendy. Thank you. So I'll just, say really, really, thank you for joining us today. I hope you found the session useful, and you can join Women's Wealth free by signing up for our Enable membership today and get access to carefully curated content. We have courses on how to invest. We have resources to help you manage money and create a fabulous financial future for yourself. We are authorized and regulated independent financial planners. And for those who need more than, need a more one-to-one service, you can upgrade your membership to suit. And if you would like to explore how working with us would benefit you and improve your financial well-being, you can book time to talk with one of our money mentors through the website. We are having a bit of a break for summer, so we'll be away for July and August, but we'll be back in September. And we've got some really great sessions planned for you then. And this recording will be on YouTube as well, so you can look back at the recordings and you can go and see many of our other sessions, Finance on Friday sessions, and some of the other sessions that we do. So do look for us, look for us on YouTube if you can as well. But thank you so much, everyone. Thanks for joining. Enjoy the rest of the lovely sunshine, and we'll speak to you again soon. Take care.
Thanks, Selina.